if you knew that the value of that was going to be at least 50% lower in 12 years, you wouldn't be so comfortable just sitting back and investing like that.
I'm only risking what I know I can lose, in a sense that I always have that foundation there. Why would I put money and save anytime if I could just put money into the S&P in a brokerage account? That S&P is going to average about 8.5% to 9%. I think it's really important to look at, or what are you needing your money to do for you to get the result that you're after? Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and I have a really exciting interview today. I've got John Wolfenberger here from Bull and Bear Profits. He is a guy, full transparency, how I found him. I was swiping through my Google feed one day on my phone, and this article, so you probably like this, John. This article just kind of came across on my Google feed as something I would be interested in. So obviously, you know, that was kind of fascinating. And I always like to click on those just for a minute. And a lot of times I'll click on them and then I'll read the first paragraph and then I'm like, this is like whatever. And I just kind of move on with my day. But then when I opened yours, Business Insider will appreciate this because I'm not a premium member, but to read your article, I needed to be a premium member. So I clicked on it and I was so captivated by the time it got to the end of the free portion I could read that I actually subscribed to Business Insider just to finish reading your article. And I'm glad I did. And so at the end of the article, I was like, man, like, I don't know this guy. I don't like whatever, but I really think the information that is in this needs to be shared. And so John runs Bull and Bear Profits. I'm going to let him kind of give his own little introduction. But I just wanted to share that little story getting into this because I think this is going to be an amazing interview. I think it's going to be really important talking about the direction of the economy, the direction of the markets, what people should be doing to prepare for that, because I just think we're coming into a bit of a winter cycle, if you will. If you know anybody out there, I know I got a lot of cycles people that watch me. And so I think we're coming into that. And so based on the article that I read, I was like just fascinated to get your feedback and get your take on kind of what's going on, why it's all happening, what people should do from your position, because I obviously, and we can kind of talk a little bit about both of our takes on that, and then you know, get into just whatever comes up. We keep it conversational around here. So
awesome, great.
Yeah, man. So if you could like talk to me, how did you get to where you are? How did you launch the bullandbearprofits.com, and give a little bit of your background and story if you could.
Sure, great. Thanks, Chris. It's really an honor to be here with you. I really appreciate it. Thank you. I always love when people are interested in my life story. Okay, so my life story is I grew up in Texas. I went to University of Texas at Austin for college, majored in business, finance, etc. Went into investment banking out of college, worked for JP Morgan, did a lot of mergers and acquisitions kind of work. One deal I worked on that was cool was helped a group buy the San Antonio Spurs basketball team. That was pretty fun. Cool. I went to business school at Duke in North Carolina, worked in investment banking some more at Merrill Lynch in New York. And then I went to San Francisco and worked for Allianz, a big German insurance company. I worked in their investment group. And I was there for 22 years. I researched stocks. I was a stock analyst, mostly tech stocks, consumer stocks primarily. I also managed a sector portfolio for a while there. And anyway, so I was there from 1997 to 2019. Wow. And so I researched, you know, the heck out of stocks for, you know, all week long for 22 years. And I learned a lot. And during that time, you know, I worked through the tech bubble of the late 90s in San Francisco. I was in the heat of the action. That was fun. And then I thought everything was great. And then we had the tech bust where the NASDAQ fell 80% in the early 2000s. And I learned that things can go up, down as well as up. And then we had the housing bubble. And then we had the housing bust, the Great Recession. Yep. And so it was kind of around, you know, in the middle of the Great Recession, I say, you know what, this is a problem. You know, these bull markets are great. You can make money. You can make money in almost anything and it's easy. But bear markets are a real problem. And I looked around Wall Street and most people had no clue that these bear markets were coming. Even halfway through them, they didn't know we were in a bear market. They didn't know we were in a recession. It was a lot of 20/20 hindsight that people had. Even, you know, multi-million-dollar earning professionals on Wall Street really had no clue about bear markets and recessions and how to see them coming. And so I spent the next several years trying to figure that out on my own. Did a lot, looking at leading economic indicators, valuation work on the markets, and then a lot of technical analysis, a lot of, and I learned that investor psychology, in school, I got a CFA, et cetera. I learned about, discounted cash flow and, doing hardcore fundamental analysis, but I soon learned that financial markets are very different than economic markets, like real estate or, when you go to the grocery store and you buy things. Financial markets are very much driven by psychology, investor psychology, and it's very herd behavior driven. It's very kind of primitive, herd behavior driven, through evolution. We learned, you saw your whole tribe running away from something. They're probably running from, a lion or something. You should probably follow them. So as a survival technique, we learned how to herd, and that's very much what drives financial markets, because no one knows what Apple stock is worth. We can argue different things, but if you just change, your discount rate on an infinite stream of cash flows, you can get very different valuations. So herding, and no one knows what Bitcoin is worth or gold, really. There's no cash flows there. So it's very herding driven, psychology driven. And so I learned a lot about technical analysis then. Anyway, so it was very educational for me. And I find it very fascinating. So I decided, I want to help teach other people what I've learned about financial markets and investing, to help people. Well, first, to help myself. I want to make money in all market environments, in a bull market, in a bear market. I don't want to get, wiped out like so many people did in the Great Recession. I've talked to so many people who've lost, virtually their whole life savings because they sold at the bottom in, 2009. And, so I want to help people make money in bull markets, and outperform the market, which I know how to do by picking stocks. I was very successful as a stock analyst and also other assets, but also make a lot of money in bear markets, which almost nobody knows how to do, almost nobody even tries to do. And it's not really that complicated. I won't say it's easy, but it's rather simple, but it's not easy, like a lot of things in life. So that's what I've dedicated myself to. So in 2019, I left Allianz and I worked on my website, and I created some webinars and some big special reports that are on my website. And I write a couple of articles a week on my website. So it's bullandbearprofits.com. I've been working on that now the last couple of years. That's what I'm doing full time. Awesome. And everything is free on the website, all the content, webinars, special reports. So go to bullandbearprofits.com, sign in, and everything's free. You have free access to everything. Later this year, probably in September or so, I'm going to launch a subscription newsletter, a monthly newsletter. That's how I'll make some money, hopefully. So sign up now, everything's free, and you'll be notified about subscription newsletter. It won't be that expensive, but it's a way I can try to make some money off of this. So that's the plan. And again, I'll have regular new webinars, new reports coming out, every few months, et cetera. So there's a lot of content there. I have a beginner's investment course teaching you how to invest if you've never invested before, how to open a brokerage account and all of that kind of stuff. So anyway, so that's the idea. I want to help as many people as possible make lots of money and beat the market in both bull and bear markets.
I love it. Well, and you and I were talking before we kind of hit the record button, and we do things a little bit differently. You focus on markets, I focus on real estate, and I think the coolest part about it to me is that it doesn't matter which focus you have, or if you do both, right? Like but the principles about why we're doing it and why we're doing things the way that we're doing it, and why we believe what we believe is super important. You just said something. There were two things that you kind of talked about that I want to go back to. Your history. You started at an interesting time in 1997. So working with Allianz, was it? So it's super funny. So I don't know how much you've gone into my content, but I'm really critical of a product called Index Universal Life Insurance. So being with Allianz, I don't know if you're familiar with the IUL products or anything of that nature.
Not an expert, no.
Allianz is like one of the products I'm the most critical of, ironically. But that said, you know, they do a lot of things. It's just one of their products. But you know, it's you coming in 1997, and then having the dot-com, kind of the back end of the dot-com bubble, or, you know, the buildup of it. And then you went through the burst, and then you went through the growth of the housing market, and then you had the Great Recession and that burst. And then you were growing up, you know, the 20 teens, so to speak, we'll just call that. I don't even know what to call that. The quantitative easing bubble, want to call it that. You know, whatever, you know, that happened. And then you left before COVID, it sounds like, in 2019. So you weren't there during that crash and then spike, right?
Right.
And so during those phases, you kind of mentioned like the bear markets are the key, right? Like, and so this is one of the things that I kind of preach really, really hard is everybody can make money when times are good. And so returns are all relative to what everybody else is doing, right? Like if I'm making 10% per year, that may look good and feel good because like historically speaking, it is what it is. But like if everybody's making 10%, did I really do well? You know what I mean? And then when the market crashes, which it's inevitable, the market is cyclical, it's not linear, it doesn't just go up. So if the market crashes and I lose 40%, like most people did in 2008 and whatever, like, and everybody else lost 40%, like, did I do bad? No, like to me, it's always like the three most important words in finance are compared to what? Like, it's a great investment. Well, compared to what? I did well. Compared to what? Like I did poorly. Compared to what? Like, we always have to be, I think the key to success is like really looking at what is the metric we're comparing our success to, you know what I mean? And so what have you learned through that phase on the psychology? Because like you hit the nail right on the head. And I think that's why I'm so attracted to like your content and whatever is the psychology behind everything. Because one of my favorite statements, I don't know if I made this up or I heard it somewhere or whatever, but I basically say life doesn't exist on a spreadsheet, you know, and we get all these models and all these pro formas and all these things like, look what it will do for you if it just, with all these assumptions. And it's like, okay, those assumptions are great. Life doesn't exist on a spreadsheet. The psychology behind everything, our human behavior, I promise you is going to take all that and turn it on its head at some point in time. Right? And so what have you learned about the psychology and what people should be doing? Like, let's break it down from a macro level and go micro, like personal finance space and how to protect yourself and your family and like prepare for what's coming.
Okay, that's a lot.
That's a lot. Right. That's a lot. Let's go.
All right, let's do it. Okay, so first of all, your point about, I just want to say something. I agree with you, but also make another point about compared to what? That is the economics and finance, those are the key words. There's an old joke, I guess you ask an economist, how's your wife? And they say, compared to what? Compared to anyway, let's see. So relative performance is what professional investors focus on, what I focused on picking stocks. You have to pick a stock, and if the market was down 20%, but my stock was only down 10%, I was doing great. You know, I was only down 10%. That's great. And I would be rewarded for that because I was outperforming the market, et cetera. But as an individual investor, which we all are ultimately, we want to make money. We don't want to lose the same money as other people or lose less money than other people. So I do think absolute returns are important, however you get them. So that's why I think, I think the average person, they go to a financial advisor and they're told, okay, put 70% of your money in the S&P 500 and 30% of your money in bonds and just sit back and you'll retire when you're 75 or whatever. Okay. And that's the thing to do. But if the S&P 500 goes down 60% as it did in 2008, 2009, and it takes, from 2000 to 2015, the NASDAQ, S&P 500 it took 15 years to break even. It took 25 years to break even from 1929. Stocks fell 90% in 1929. or the early 30s, and it took till the mid 1950s to get back to that 1929 level. And if you're, if you're going to live to be 200 years old, maybe you don't have to worry about that. But if you're 50 years old, I'm 53, I don't want to lose money for 15, 20, 30 years. If you're getting cash flow, you're getting dividends, that's great. That's a separate story. But if you're depending on the absolute value of your investments, you don't want to lose money for 10, 15, 20 years. So that's why I think it's really important to understand these bull and bear market cycles. So transitioning towards psychology, I think one of the most important things is really being an independent thinker, no matter what you do. So
Sure.
Warren Buffett, you've probably heard of him. He's a very famous, wealthy investor. He's made some money over the years. He said, I live in Omaha, Nebraska. I don't live in New York. I don't want to talk to hedge fund guys all day. I don't want to be, in the group think of Wall Street. I want to sit back. I want to read things. I want to look at facts. I want to think about things. And I want to profit from the folly of Wall Street, from the mistakes that the herd gets into. And the herd, it's not just individual inexperienced investors. It's the most, the professional investors, they're compelled to participate in bubbles, essentially. So right now, professional investors they've been borrowing money to buy stocks. So they're levered to buy stocks right now, even though, this is after this enormous rise at the highest valuation levels. Stock market's at the highest valuation levels now since 1929. And, people they couldn't be more bullish. They couldn't be more excited. So it's easy to get caught up in the herd of psychology, but you really have to think independently and look at the facts. So I think that's one thing I would say. So just a couple of really key points I think everyone should know who's investing in stocks, let's say, and if you're investing in Bitcoin, for example, that's great. But historically, in the brief history of Bitcoin and other cryptocurrencies, they track the stock market extremely closely. It's basically a levered version of the NASDAQ. It's basically it's like a really speculative tech stock is how I think of a Bitcoin. So risk assets, like cryptocurrencies, stocks, a lot of commodities, they're all highly correlated. They all go in these general boom and bust cycles together. So let's just say they're all, more or less correlated. But if we take the stock market, right now, I think in this article you may have read, and certainly I talked a lot about it in my webinars and special reports, the valuation of the stock market is, again, the highest levels in history, near 1929 levels. It took 25 years for the stock market to return to 1929 levels. About 12 years after 1929, the market was, I think about 50% lower or so. Right now, based on this valuation level, there's a valuation metric, which I discuss on my website. I think it was in that article. Essentially, it's the total value of the US stock market divided by the total economy, the total GDP of the US. And this ratio you can track over time. It's actually Warren Buffett's favorite valuation metric for the stock market. And if you track this over the last 100 years, it predicts the next 10 to 12 year returns for the stock market with about 92% accuracy. So just based on this one ratio, you can forecast the total returns of the S&P 500 over the next 12 years with about 90% accuracy, which is amazing. And most people have never heard this is possible. Anyway, based on the metric now, it tells us with 90% plus accuracy, the stock market will likely be at least 50% lower in 12 years. So at least 50% lower 12 years from now. So if you have, 50, 70% of your money or 100% of your money in the stock market, like a lot of people do,
yeah,
if you knew that the value of that was going to be at least 50% lower in 12 years, you wouldn't be so comfortable just sitting back and investing like that. It's fine as long as we're in a bull market. That's great.
Yeah.
If you knew for a fact, and 90% is pretty close to a fact, that you're gonna lose half your money in 12 years, you might want to think about how I'm gonna deal with that. How am I gonna profit over that 12-year period? So anyway, I can stop there if you want.
No, that's awesome. I want to ask you a question on this. So you've been doing this for 30 years, you said, since,
Yeah, about the early 90s.
So it's interesting. You're a little older than me. I was born in 1980.
Okay.
And so one of the things I did this thing last year because, doing what we do and focusing on our philosophies and strategies, I'm really big on saving money first. Even I know there's an opportunity cost to saving money because if I'm just saving money and getting safe returns and whatever, then I lose the opportunity to gain some upside potential, which, for a lot of people sucks in a bull market because you like look at that and the herd mentality and the water cooler talk at work and all that stuff. Like you feel like you're missing out and there's that FOMO, and like it is what it is. But I'm really big on not just like where we put our money, but structure of how and when we put money into different assets, right? And when we take different risks on and like have all that stuff. And so I'm really big on building like a good financial foundation of safe, liquid, accessible capital. That way, when I go and invest in whether it's real estate or stocks with you or something else, like I'm only risking what I know I can lose in a sense that I always have that foundation there. And to me, that's just good business, like that's
Absolutely.
just, but most people are not doing that. You know what I mean? And so I get a lot of pushback from, people that don't agree with what I do. But like, to me, it just seems like important to build that foundation. Now, I say that to kind of like now pivot to say, all right, when I was doing this research and when I was trying to do my own stuff, and I am by no means, an economist like you or a banker like you have access to infinite higher levels of data than I do and all that stuff. And you're way better than I am at this stuff. But my basic rudimentary research, I went back through and I said, because one of the things I get from a lot of people is like, why would I put money and save anytime if I could just put money into the S&P in a brokerage account and over, from 1925 to now, that S&P is going to, with dividends, is going to average about 8.5 to 9%, right? And I said,
Right.
okay, that's cool. And it's not wrong, right? But then what I did was I got curious and I remember looking at this period of time from 1980 to 1999, right? And I look at and I go, all right, why? Because I'm really big at asking why. And I don't know if you've ever thought about this. So I'm really curious to hear your feedback on this. Because from 1980 to 1999, what did we have? We had interest rates at super high levels and they went down, right?
Right.
And that just drives the economy up, right? That drives stocks up, valuations up, money's cheaper, everything gets more affordable, right? And all valuations and costs of everything go up. And so, okay, that happened. Interest rates were going down. In 1981, 401ks became a very normalized way. So the average Main Street employee, rank and file employee, went from not being in the market to having now almost every person in the world was buying mutual funds and stuff like that. So that helped drive markets. Then we had the dot-com bubble during that time, which blew everything up. And so if you look at 1980 to 1999, and I'm sure there's some other things that, added to all that, but I just, once again, just keeping it really, really simple because I like to take all this complex stuff and try to make it as simple as possible. The average return during those times were almost 15% when you account for dividends and all that stuff. And if we took that 20-year bubble out, because I don't think we're ever going to see another 20-year window like that in my lifetime. Like, I don't see it happening,
I agree.
If you disagree with me on that, then we could have a different argument. But like, I don't think we're going to see another 20-year window like that. And if you take that 15% away over that 20-year period, that is a huge inflection point on the overall long-term averages of the S&P and the performance and the expectations of what we, when we just put our money to buy and hold and set it and forget it and like whatever, that impacts it, right? And so if we take that away, that 8.5% that we expected, I broke it down and it was about 5% that you would expect from the S&P after all things are done over a long period of time if we just take that bubble out. Now, I don't know what we would replace it with from a fundamental model perspective, like if what would have replaced that time frame, what would the numbers have been. But if we just eliminate that and just look at all the other numbers and all the other years, it's really not that dependable, like from like really what people are expecting. Because when we say compared to what, I think it's really important to look at like, what are you expecting or what are you needing your money to do for you to get the result that you're after?
I think too many people focus on like, what's your rate of return versus like, what's the result you're after and how are you going to accomplish this result? Does that make sense?
Absolutely.
So what are
I
your
agree.
thoughts? Like, what are your
Yeah.
thoughts? Like, what do you have to say to all that? Like,
Okay. Well, I'll break it down even more simply. That I think your analysis was spot on, but
okay.
even more simply, just back on this valuation metric I talked about for the stock market.
Yep.
In the early 80s, this valuation metric was one of the lowest in history. And it would have told you that the next 12-year returns would be about 15%. I'm looking at a chart right now
okay. Oh, awesome.
So just because, okay, just a little bit of history. In the 1966 or so was sort of a stock market top. I think the Dow was basically flat from 66 to 82, I think it was.
Yep.
And 1966, Warren Buffett, he had like a fund he was running, and I think it was around in the late 60s. He, I think, basically gave the money back to his investors. He said, I can't find anything to invest in now because the stock market's so expensive. It's not a good time to invest. And he basically kind of liquidated. People say he's not a market timer, but he definitely is. And you know, and then in 70, after the 74, 73, 74 bear market, which was the worst since the early 30s, he said something like, I feel like a oversexed man in a harem or something. Like there's so many things to invest in now. Anyway, the point is valuations really matter, and they were expensive in the late 60s, and then they got super cheap in the early 80s. And it's because of, you know, we had Watergate and we had, you know, all sorts of problems in the 70s. There was like a lot of human mass psychology going on. It was 70s were kind of a downer period in a lot of ways. And that negative sort of social mood psychology drove stocks to really cheap levels. And you had, yeah, the inflation and the high interest rates. It's all related. I mean, you could have invested in treasury bonds and made 15%, right? Because treasury bonds were
crazy. Yeah.
Anyway, yeah, but it's not. Anyway, so the point is the valuation of the stock market got so cheap in the early 80s that it did lead to this, you know, these incredible returns over the next, you know, 20 years or so. And then it usually the end of a period by the late 90s, people look back, oh my God, the last 10 years you made 15% or whatever. So let's just buy anything and let's stop even analyzing anything. Who cares if they make money or if they, you know, there's some stock puppets or whatever. We just buy anything. And that leads to your, you know, your euphoric top and then the inevitable bust. So yeah, so valuation is really important. I agree with you. So until the stock market gets really, really cheap again, like it was in the early 80s, which I agree with you, we're the opposite level now. It's going to take a lot of misery, you know, probably at least 10 or 15 years of really miserable returns. So maybe in 12 years, if the market's at least 50% lower, you know, maybe then, you know, you and I, you know, anyone could buy an S&P 500 index and just sit back and make double-digit returns without thinking. And now we have another thing I want to touch on there are some pretty cool financial innovations. One is with ETFs. There are levered ETFs now, right? So there are double and triple. I don't really like doing more than a double, but if you bought a double levered S&P 500 ETF, and if you had high confidence the S&P was going to go up at least 10% because valuations were so low, you could buy a double long and make at least 20%. Wow. You know, so that's really cool.
I wouldn't do that right now, though, would you?
No, because again, if you're going to lose 50% until
I just want to make that clear for anybody watching.
No, that's not my advice. But if we're in a bear market, the other innovation are these inverse ETFs.
Yeah.
And they're really simple. It used to be, to your point, like you're saying with 401ks, I mean, we have a lot of financial innovation that people don't really think about.
Yeah.
But 50 years ago or something, it was hard to go buy a stock. You know, you had to call a broker, you had to be pretty rich. Generally, you couldn't just have a few $100s. It was hard to buy a stock, and there were big brokerage fees and et cetera. It was really a rich man's game. And now anyone can buy and sell stocks for free, you know, with online, you know, brokerage firms. Anyway, so to profit in a bear market used to be, you know, Joe Kennedy back in, you know, the early 30s, he made a fortune with the stock market crash and the Great Recession because he was shorting stocks. But shorting stocks it's difficult. It's stressful. But you can buy these inverse ETFs that move in the opposite direction of the market. So in 2008, 2009, when the S&P fell 60%, you could have bought an inverse ETF that made at least 60%, or a double inverse ETF that made 120%. And so you could have made 120% in, it was about 18 months if you time things correctly, which, we could talk to it at some point.
How does that work though? Like if I bought an inverse ETF, does it actually mirror? Like, so if the market loses 10%, I make 10%. If the market goes up 10%, I lose 10%?
Yeah. Yes. It's just
Literally,
the opposite.
it's a mirrored effect.
Correct. And it's on a daily basis. It's every day. It tracks it every day. Which can, so actually, and it's a little technical, but if you get the trend correctly, like if you bought an inverse ETF, let's say at the beginning of 2008, at the beginning of that bear market, and you held it through, and during the period when the S&P fell 60%, if you have a strong, steady trend like that, you'll actually earn more than the inverse. So earn like 90% instead of 60% because of the daily sort of compounding.
Wow.
If you get the trend wrong, you could also lose more than you expect. So it's, it's a double-edged sword like leverage, as I'm sure you're familiar with. Yeah. But it's pretty cool. And you just buy it. You don't have to borrow by margin. You don't have margin calls. You just buy it and sell it like any other stock. So it's really easy. You just got to get the trend right, which is a lot of what they do on the website. So.
That's awesome. That's amazing. So what do you suggest to people right now? Because like what I see.
Sorry, I can't hear you now.
Oh, is the audio? How about now?
Okay. Now I can. Yes.
Okay. Perfect. Mikhail, edit that out. So what do you see as what people need to do right now? Because like when I look around, and we do a lot of personal financial coaching for people, right? And look at a lot of like financial statements, a lot of people's, debt and credit, and trying to help them build their financial foundation. And unfortunately, I see a lot of people that are really exposed and really at risk, and I'm really concerned about kind of the future of the United States. It's one of the reasons I came down here to the Dominican, and we invested down here because I couldn't find anything in the United States. I mean, I think kind of like stocks that you're saying the valuations are at all-time highs. Well, real estate, I think, is in the same boat in the United States, and I think it's a calamity waiting to happen across the board, just in the financial markets as a whole. So I came down to the Dominican and launched my private equity fund to invest down here because of the fact that I just feel like the risk return and the valuations are completely the opposite. You can get things down here. If you saw what I could buy for the price that we're buying and building down here, it'd make your head spin, like and especially when you compare it to like what's done in the US. And so like, that's why I made a really bold move. I just moved my family of 5 down here. I know you said you live in Portugal, right? Like, so, you obviously have made some shifts in your life. Obviously not everybody can move to the Caribbean or Portugal and like has the resources or the desire or the career potential to be able to do that. But all that said, like, what is your like maybe top 3 tips or top 3 pieces of advice of like what the average American family household should do to prepare for what's coming, understanding that we're just not going to be able to time this perfectly. It's going to unfold in a way that nobody really knows, but it's inevitable, almost inevitable that it's going to happen.
Agreed. Thank you. This is an excellent topic. Was it Ben Stiller? Somebody says if something can't continue forever, it's going to stop or something like that. Yeah. There are trends. Yeah. The valuation stock market can't continue. It won't continue like this forever. The valuation, real estate, the price to rent ratios in the US are near historical levels from what I've seen. And now we have interest rates have skyrocketed the last couple of years. I mean, it's a totally different ballgame with what's happened to interest rates. The government debt is it's out of control. I mean, it's in every country. I mean, Portugal's no stranger to government debt. The U.S. government debt, it's out of control. And if you look at the interest expense on the debt now, I think it's close to the highest, the biggest expense item in the national, in the U.S. budget. It can't continue. The spending has to be cut, which means I think there's a lot of risk to Social Security payments for people. People are counting on Social Security. There's a lot of risk to that, unfortunately, a lot of risk. Medicare, Medicaid, I mean, there's a lot of risk to these benefits that people are expecting, particularly as they get older.
Yep.
Yeah, so interest rates are up a lot. We have an inflationary problem. You know, the Federal Reserve increased the money supply by over 40% in response to COVID. And now we have the highest inflation rates in 40 years. We have the Fed hiked interest rates, the most aggressive pace in 40 years. To me, it looks like a little bit of a replay of the 70s, that 70s show. I think, you know, we're going to be it seems like we're in an above average inflationary period. Interest rates are going to be a problem. That's usually a very difficult time for stocks and bonds, just like it was in the 70s. We've already seen bonds have the biggest losses, I think, in history, in the last, 50% decline in bonds in the last couple of years. I think real estate is going to be challenging in the US, real estate prices. Stocks, we've already talked about. Bonds are challenging. I do think commodities, similar to the 70s, will probably be the best performing asset class like they were in the 70s. One, because valuations of commodities relative to GDP are very low, because nobody's cared about commodities generally last couple decades. So valuations are very low on commodities. People aren't talking about them. In the 70s, they were talking about them like crazy. They were talking about gold and Swiss francs and all these other things to beat inflation. And I think the next 10 or so years is going to be kind of like that. So I think commodities are interesting. Gold, Bitcoin, so far I have hope for it. I like the concept of it, but so far it's just tracked the NASDAQ. So I think it's going to be in trouble if the market falls a lot. So anyway, that's a long way of saying for the average person, number one, try to get out of debt as much as possible. Now, if you have productive debt for real estate, that's great. But if you're, just consumer debt, car debt, you want to get out of debt as much as possible. We've already lost in the past 4 months, 1.8 million full-time jobs have been cut. I think we're going into a pretty big recession. It may have already started, but I think this year we're going to have a pretty good sized recession in the US. It'll probably be more or less a global recession, which typically happens. So I think a lot of people are going to lose their jobs, full-time jobs this year, next year. So you want to stay out of debt. I agree with you. You want to have savings. I would say, everyone needs at least 6 months, if not 12 months of living expenses saved. You can put that money in a money market fund and earn 5.5% right now, which is pretty good. So it's very safe. Have at least 6 to 12 months of living expenses in a money market fund, pay off your debt. And then, like you and I are doing, I think, try to, develop skills, something where you're not reliant on an employer, you're not reliant on a job. I know it's hard, but it's a lot of fun. I think you would say the same. I've had a lot of fun trying to start my own thing. It's a lot of fun being your own boss, not having to answer to a boss. And so, any skills you can, anything that you're interested in, there's so many ways to make money online now. You have a global market now with the internet, with Zoom and everything. There are so many ways to make money based on whatever interests you have. It just takes a little bit of creativity and a little bit of hard work for a period of time. But try to side hustle, they call it. Try to come up with something to do, so you're not relying on other people. So yeah, pay off your debt, build up your savings, build up your own career, your own business. Those would be the top things to do. And then if you have extra money left over, go to my website and I'll show you how to try to profit in bull and bear markets.
I love it. I love it. You said one thing that I want to push back on a little bit and question you. So it's not even really a pushback, but it's you talked about if you have productive debt with real estate, that could be okay. In the past I've kind of agreed with that, but now with valuations as high as they are, and if you are over levered in debt, or if you have debt in the, like a lot of people that go out right now, you said it yourself, like rents to valuations are kind of whacked out right now. We're in the process because we just moved here. We just rented our house in Arizona. I could not convince my wife to sell the house, but we're renting it. We actually just had a guy who got into the US on an H-1 visa working with a big company that everybody would know, and they're going to pay his rent. And we got like a 5% increase built into the lease, but he signed a 4-year lease, And so to me, that was exciting, knowing that we could lock it in at a 4-year lease with a 5% increase, because as markets go down, we got that locked in, so that insulates me honestly, it's the only thing that gives me peace of mind around not selling the house, you know, is the fact that we get the rental cash flow locked in, because otherwise I would be worried that the price would go down and rent prices would go down and everything would go down, right? And we'd be exposed to that, you know? But I think there's risk, you know, the same way as like investing in stocks right now, you know, there's risk that you're investing at all-time valuation highs. I think it's even worse on the real estate side because people are investing and buying at all-time highs and valuations that are way out of whack, that make absolutely no sense. The problem with real estate is almost everybody's using leverage and debt to do it, right? And so that actually creates more of a risk. And what happens is when markets start going down, I call it the pendulum effect, you know, where it's like the markets should be here, but when it bubbles up, it goes way over here. And then instead of going back to where it belongs because of buyer behavior, over leverage, and then like it always, things don't get to the prices they belong at. They go cheaper than they belong at because of buyer behavior, right? And so to me, that's where I'm like, I'd rather just be really safe with my money, you know, and wait for when they go super cheap and gobble up. I'll make 3, 4, 5% for 10 years. And then when things get really cheap, I'll make way more than anybody else over the next 10 to 15 years. Now, I'm not old enough, quite frankly, to acknowledge that I've lived a cycle and done that personally, right? Like, but when I look at the math of it all and I look at the human behavior and psychology, you know, I'm setting myself up for that. You know what I mean? And that's what I want to be prepared for, right? And so I'd be curious to hear your feedback on kind of that framework of thinking.
I completely agree. Yeah, I would not be, I personally would not, well, I personally, as you know, would not be buying a house right now in the United States at these interest rates with a lot of debt. Because again, if we have a recession, like I think, and we can talk about why I think that, but if we have a recession and we have a major bear market, I think it's a very good chance it's going to be worse than 2008, 2009, which would mean it's the worst bear market and recession since the Great Depression. I don't think it's going to be as bad as the Great Depression, but I think it's going to be worse than anything we've seen since then. I think it has that potential. Therefore, yeah, I would say I have no debt. And I would say if you have no debt, that's fantastic. And I agree with you. I mean, the ideal is at the very least, you sit tight on money in a money market fund or treasury bills earning 5.5% interest, which is nothing to be ashamed of. And then you wait for things, you know, prices of real estate and stocks and everything else to come crashing down. And when you see signs that the economy is getting better and, you know, the sky is opening up, then you can buy things really cheap and put that money to work. So I agree with you.
Okay, I got another question. And these are just kind of coming to my brain. So like, what is your take? Because you mentioned, and I read this in your article too, you know, the 12-year indicator, 10 to 12-year indicator on Buffett's favorite you know, metric or whatever, says that on average we're due to lose about 5% per year on average over the next 10 to 12 years. Okay, so that's the case. Is that a nominal thing, or does the government have the ability to manipulate that and monetize that and inflate that and make it all convoluted?
That's nominal. That's set in stone, basically 90% set in stone. As set in stone as you can get in the financial market. Yeah, there's nothing the government can do. There's no GDP.
They can't create more inflation, which, by the way, inflation doesn't solve the problem. People will feel the pain and all that stuff, but from a nominal perspective, they inflate everything.
No, these are nominal absolute returns. Yeah. You know, again, in the 70s, you had more money printing and inflation, and it was terrible for the stock market.
Well, that's the other thing. You know, we talk about the debt right now, and interest rates going up. You said that the interest expense on our debt is like one of the highest, if not the highest line item on the national, you know, budget.
More than Social Security, twice what national defense is. I think all the money we spend on national defense, it's more than, yeah.
It's mind-numbing, and it has the potential to just get worse and worse and worse. And this is where things, if anybody understands compound growth, and we always talk about compound growth in a positive way, well, we're compounding in a very negative way right now. You know what I mean? And Problem is when you're compounding in a negative way, it all feels great until it's not. And when it's not, it falls off a cliff. And that's, I think, where we're headed to. Is that a pretty simplistic way to kind of speak about it?
Yes. Yeah, I think we're heading towards a major federal government fiscal crisis. And, you know, we saw it happen in Greece, you know, 10 years ago, or Portugal, or, you know, a lot of Southern Europe. Those countries couldn't print their own currency. The US can print their own currency. So how does the US get out of it? You know, the main way, I think it's, you know, the main problem is there are these, there's the actual budget deficit we have and the debt we have. But the debt now is, you know, I think it's 120% federal debt to GDP. But there's also unfunded liabilities, they're called, which are all the promises the government has made for Social Security, mostly Social Security, Medicare, Medicaid, the healthcare, and the Social Security for retired people. I think it's over $200 trillion.
228 trillion last I looked.
Thank you. You know what I'm talking about. And some economists have really analyzed this. Yeah, so there's all these promises the government has made to people that people are banking on, and it's just not physically possible to meet these promises. And of course, politicians, you know, they just kick the can down the road and they don't want to deal with it during their career. So nothing, you know, it's not getting solved. So we're just spending more and more money. We're going deeper and deeper into the hole, the government is. And I think it's just going to end up, the main way it's going to end up is people are not going to get the Social Security and the Medicare and the Medicaid that they're expecting. So they're going to have their own financial assets to live on if they want to retire. You know, you can work forever, and that's great. I'm all for work.
Well, maybe,
but, you know,
what if you get sick? What if you lose your health? What if, like, I mean.
Yeah, exactly. So obviously insurance is important. So yeah, insurance is you know, I don't have time to talk about that now, but, you know, talking to a financial advisor, getting all your insurance in order is good. So yeah, I think there's going to be a major fiscal crisis. It's really going to hurt people, especially as they head into retirement on the Social Security and Medicare front. I think that's the main way it's going to manifest itself. I personally don't know how we can maintain military bases in every country in the world and fight endless wars everywhere. I mean, that costs a lot of money and doesn't do much for us. So I think, you know, I think it's a classic case of an empire that has overextended itself. We've seen it throughout history. US has overextended itself. We're spending all this money that we can't afford. And I think the US is going to have to retreat, you know, foreign policy wise, but also on the fiscal front. And this, this fiscal problem, Social Security, it's a huge problem in Japan. It's a huge problem in Europe. This welfare state spending that, you know, worked for the last, you know, 50, you know, 75 years or so, you're running out of money, and there's going to be a financial crisis. And first, we're seeing it in inflation. You know, they inflated away. So I think inflation's probably going to be a bigger problem, which means interest rates are going to be a bigger problem, which means debt's going to be a bigger and bigger problem.
Yep.
So, you know, the baby boomers lived off debt and Social Security and Medicare and Medicaid. I think that's going away. So for people like us and even younger people, it's going to be a totally different ballgame where we're going to have to rely more on our own work, our own career, our own savings, our own investing. And that's why learning how to invest either in real estate or financial markets is going to be extremely important for people.
I love it. All right, well, I got 2 more questions for you before we end. I think these are going to be good. What, if any, research have you done as to how markets behave in a presidential election year in the United States? And I guess a simpler way to put that is, how do you think the fact that we're in this spot will impact everything? Because my natural inclination is always like, these are the years where things get manipulated more. You know, like my common sense kind of vibe with all the research I've done just kind of says markets tend to perform better than they otherwise would have during an election year because of that manipulation. And then typically it's the year after that, when there's a change in power, that something happens, right? Like, and then the new incoming president gets to be like, oh, well, that was the last guy's fault, right? Like, and I'm going to fix it. Right. And this is the cycle of it. It doesn't matter, Republican, Democrat, whatever. This is just the cycle of it.
Absolutely. No, you're exactly right. That has been the general pattern in history. And That is true. So we have until November. It is possible they could keep things afloat until November. I think my sense is the Federal Reserve would like to do that. Obviously, the administration would like to do that. Janet Yellen, the Treasury Secretary, would like that. I think they would like that. I think that is probably a good reason why the Federal Reserve, Jay Powell, and lately has flip-flopped and become, well, he was becoming more dovish and talking about rate cuts this year, even though inflation is still above their 2% target. The stock market's at all-time highs, talking about inflation's still high, unemployment's still low, but so why rate cuts? Why rate cuts just before an election? So I think they would like to do that. I agree with that. And then, yeah, once the election's over, whoever wins, they don't care. Then they want to get the recession, the inevitable recession, get it out of the way. Reagan did in the, get it out of the way in the first year or two. And then when they run for re-election or the next election, then they can, the economy will be expanding. So that is the pattern. I think they would like to do that. I think that's generally what's been done historically. This year, I don't know, because there's two problems. One is we've already started to see, as I mentioned, 1.8 million job cuts, full-time job cuts, which I have a chart on my recent articles. That only has happened in recessions. And usually it's about halfway through a recession, not even the beginning of a recession. So we're already seeing the kind of job cuts that you see deep into a recession.
Yeah.
So I don't know. I think it's typically the Fed started hiking rates about 2 years ago. Typically, a recession really kicks in about 2 years after rate hikes start, and about a year and a half or so after the yield curve inverts. And the yield curve inverted, year and a half ago. So we're on schedule right about now for a recession to really kick in, and we're already seeing the job cuts. So I think right about now is when a recession normally would kick in. So I don't know if they can hold off till November. Also, the latest inflation data that came out a couple days ago, which I wrote about in an article, came out. I posted it just, I think it was yesterday on my website. Anyway, inflation is accelerating again. And now Fed rate cuts seem to be off the table for June. And if they can't do it by July or so, a rate cut, inflation, there's signs that inflation may accelerate quite a bit further. There's leading inflation indicators that suggest it's going to accelerate further. Then the Fed can't, with a straight face, justify rate cuts. And you can't cut, you can't cut in October. You can't, the closer you get to the election, then it looks like it's becoming obvious that they're trying to influence the election. So I think there may be no rate cuts this year, which the stock market has really been looking forward to. So if inflation accelerates and unemployment rate really starts rising even more than it already has, that's kind of a perfect storm of an inflationary recession, which I think can lead to this massive bear market that I'm worried about. And I think that could start happening before the election, in which case the incumbent, who happens to be Joe Biden, will probably not be elected. That's based on history, when the stock market is a very good indicator of who wins the election. If the market stays at the highs, Biden likely wins. If we start having a bear market before the election and a recession, then pretty good chance he loses, depending on what the other candidate does. But anyway, so and I'm not a fan of either one. Anyway, but
I'm with it.
So I think we could start having major signs of a recession, as well as even accelerating inflation, possibly no rate cuts, unemployment, all before the election starts. So I think they might be able to thread the needle and get through the election, but I think time is running out on that.
Do you think there's a chance if June, July inflation starts going back up and it goes up maybe faster than they expect? Do you think there's a chance that they're forced to actually increase rates again?
Yeah, I think so. Yeah, the best way to figure out what the Fed is going to do is to look at market interest rates. And the 2-year Treasury rate is really good leading indicator of the Fed policy. The 3-month a little more coincident with the Fed, but I would watch that 2-year Treasury rate. And the Fed they didn't ever want to raise rates. They didn't want to raise rates 500 basis points. They had to follow the market rates. If you look at the two, you can track them historically. The Fed follows let's say the 2-year rate, because what the Fed because the Fed knows, the government knows how much debt they have, they can't let interest rates get up to 10% or 15% or 20%, like they did in the early 80s. That's a real problem. So they gotta keep market rates, because they don't control market rate. They have to keep market rates from getting out of control. So the market's telling them when that market rate, the 2-year rate starts going up, the Fed's like, okay, we gotta listen to the market, and we gotta follow the market, and we gotta tighten money supply to get this inflation down, because we can't just tell the bond market what to do. The bond market's going to do what it's going to do, and we have to listen to it. So yeah, if you start seeing that 2-year rate go up because inflation's going up, and you've already started to see that, then yeah, the Fed's going to have to follow. So they have no choice in the matter, really, unless they wanted to sit back and destroy everything and have interest rates, market rates go to 10% or more.
Yeah. Well, so let me ask you this. This is and this is a personal thing. But what was it like? How long have you lived in Portugal now?
Almost 5 years.
Almost 5 years. So what was your reasoning for doing it in like 5 years ago? Because like that was before COVID, that was before like all the chaos, and all that stuff. So it's actually
my crystal ball was really effective back then. Yeah. No. I have this crystal ball. I didn't tell you about that part. No. We did get lucky at the time, because my wife and I were living in San Francisco, and my understanding is San Francisco, since COVID, has become a lot worse in terms of homelessness and crime, and it's become pretty sad. So we're very thankful we got out before COVID there. We left, I was 48 years old, and I was really excited to start BullandBearProfits.com, and I had accomplished what I wanted to accomplish in my career. So it was purely a personal, just lifestyle decision to start the business and move on. And we really wanted to live in another country. We like Portugal because it's similar to California in terms of the weather, beaches and that kind of thing. And we really like Europe, the culture and the history and the art and everything. So we wanted to live in Europe, but with kind of a California weather type situation. And people speak very good English here. And
that's nice.
It's a very safe country. I'm sorry?
Do you speak Spanish or Portuguese or anything?
Un poco de español. I grew up on the Mexican border in Texas, so I know a little Spanish, but I've become confused now with Portuguese. So I know more Portuguese than Spanish now. But
that's awesome.
It's not as simple as Spanish, but the people speak very good English here, thankfully. So that's good. But yeah, we've really enjoyed it, and I would encourage anybody. The U.S., it's sad what's going on politically there. I think there's going to be this financial crisis. There's a lot of other countries in the world that are a lot cheaper to live in. Particularly if you start your own business. If you're working online, you can live a lot cheaper and a lot safer, a lot less crime, and you don't have all the drama over politics that seems to be going on in the U.S. So we're really happy living here, and I'd encourage anybody, if they can, to consider leaving the U.S. I know it's
totally
a shocking statement for many people, but we're really happy we did.
I love it, man. Well, that's awesome. And I moved down here to the Dominican for a lot of the same reasons. So that's awesome. Well, I just got to thank you for being here, man. This has been a lot of fun for me. Maybe we can do it again sometime. Like, as things keep evolving, we can do this. I would really, really encourage everybody, if you are, here, whether it's for the first time, subscribe, hit the bell, that way you're notified every time I launch a new video. For John, go to BullandBearProfits.com, and he said it earlier, he's got a lot of really, really amazing free information. I would encourage, when he does decide to monetize it, subscribe. It's like, I'm a real big believer in investing in yourself and investing in information and knowing this stuff, and the price for that kind of stuff is just such a nominal fee compared to the value and the benefit that you get from it. So I would really encourage everybody to go check it out, subscribe to his newsletters, subscribe to like all his stuff, go to his website, opt in, get his forms, his white papers, and all the different things that he does. Like, go do it and read it and dissect it. And he speaks about it in a much more technical way than I do, because he's much more technical than me. But it's all the stuff that I preach about every single day. So I really, really encourage everybody to go do it. And I just want to thank you for taking the time. I was really excited when you agreed to come on, because I love doing talks like this with people that I just met. I look forward to building a relationship with you and seeing how it goes.
This has been great, Chris. Thank you so much. Appreciate it.
You got it, man. Is there anywhere else people can find you, or is it just your website? Are you on Instagram or YouTube or anywhere else that we can kind of push people?
We do have a YouTube. I do have a YouTube channel. I think I have 2 videos in there. Don't bother with that right now. But I'm on pretty active on Twitter, X. I'm at John Wolfenberger on Twitter. I'm also on LinkedIn. The Twitter, LinkedIn, and then bullandbearprofits.com. Yeah.
Okay. All right, guys. Well, thanks so much for being here. Go check John out. Make sure if you have any questions, comment in the comment section below. I do my best to engage with every single comment I can. If you have any feedback, any questions, ask away. And if I got to get John back on here, I'll reach out to him and we'll make it happen. So until next time, have a blessed, inspirational day. We'll talk soon.